Good morning. Welcome to Esquire Group's webinar on domestic entity FATCA reporting requirements. My name is Jimmy Sexton. I am your presenter today. I hope that you find this webinar interesting and useful. So, first we're going to start off with a little disclaimer to protect ourselves. So this presentation is for informational purposes only. This presentation was prepared for educational purposes only. This presentation is not legal or tax advice, nor is it to be construed as such. Each individual circumstances are different. You should seek legal and or tax advice to address any specific questions you may have. Again, I'm your presenter, Jimmy Sexton. A little bit about me. My educational background, I have a bachelor's in business administration with an emphasis in finance, a JD and an LL.M in international taxation. I'm the president of Esquire Group, which is an international tax advisory firm with offices in Las Vegas, Phoenix, Vienna, Austria, Frankfurt, Germany, and Dubai in the United Arab Emirates. Esquire Group specializes in international taxation, including tax issues facing citizens and resident aliens of the United States and that live abroad, expatriation, investing, we're doing business abroad, and foreign investment in the U.S. I'm fluent in English and German. You can find my full bio on our website at esquiregroup.com. So, moving right along, I'm sure a lot of you have heard of FATCA. It's the acronym for the Foreign Account Tax Compliance Act, which became law on March 18th, 2010. FATCA imposes various reporting requirements on foreign financial institutions, specified individuals, and specified domestic entities. Specified individuals and specified domestic entities are required to file Form 8938 to report foreign financial assets if the filing threshold is met. Now, specified individuals had to start filing Form 8938 back in 2011. At that time, the final regulations outlining the filing requirements for specified domestic entities to file Form 8938 had not been finalized. And so specified domestic entities have not had to file Form 8938 up until this point. The tax returns being filed for tax year 2016, so the tax returns that are being filed in 2017 to report the 2016 tax year is going to be the first time that domestic entities may have to file Form 8938 if they meet the criteria for having to file. This presentation is only going to cover the Form 8938 reporting requirements for specified domestic entities. We're not going to be talking about the filing requirements for specified individuals or for foreign financial institutions. So, who is required to file? Which specified domestic entities are required to file Form 8938? And specified domestic entities must file Form 8938 to report specified foreign financials if they meet the filing threshold. So this sentence obviously begs a lot of questions. What is a specified domestic entity? And what are specified foreign financial assets, or SFFAs for short? So we're going to go through all these definitions, and we'll come back and look at this sentence again later, and hopefully you'll have a better understanding of when a domestic entity would be required to file Form 8938. So first off, a specified domestic entity is a domestic corporation, partnership, or trust formed or used for purposes of holding directly or indirectly specified foreign financial assets. So the definition in and of itself requires us to look deeper into some more definitions. For example, what does it mean to be formed or used for purposes of holding specified foreign financial assets. So in the case of a domestic corporation or partnership, it is treated as formed or used for purposes of directly or indirectly holding specified foreign financial assets if it is 80% or more owned by a specified individual, or at least 50% of its gross income or assets are passive. So we need to look at who is a specified individual and what is passive income and assets. So we'll take a look at that in a bit, and we'll come back to it. Domestic trusts are treated as formed or used for purposes of holding specified financial assets if one or more specified individuals or specified domestic entities is a current beneficiary. So we have to answer the question of what is a current beneficiary. We will answer that question, but before we do, I think it's important to point out that on this slide, the tests for whether or not a corporation, partnership, or trust is a specified domestic entity are specified. And so the determination of whether an entity, a domestic entity, is a specified domestic entity is something that is determined annually. So you may have a domestic corporation, partnership, or trust that is a specified domestic entity in one year, but not in another year. So you have to put the entity and subject it to these tests every year to make that determination as to whether or not it is a specified domestic entity. So what we're going to be looking at here, we're going to look a little bit deeper into what is a specified domestic entity, what is a specified foreign financial asset, what does it mean to be formed or used for purposes of holding specified foreign financial assets, who is a specified individual, and what are passive income or assets, and what is a current beneficiary. And once you have an understanding of these definitions, it should make these tests to determine whether or not a domestic entity is a specified domestic entity a lot easier. So specified individuals are U.S. citizens, U.S. resident aliens, and U.S. resident aliens include permanent residents, commonly known as green card holders, as well as aliens meeting the substantial presence test. Basically, a foreigner can become a U.S. resident for tax purposes simply by spending too much time in the United States. And how much time is too much time? That's determined by applying the substantial presence test. So I'm not going to get into the details of the substantial presence test, but just know that a foreigner that spends too much time or spends a lot of time in the U.S. Should determine if they meet the substantial presence test, and if they do, then they would be a specified individual. A specified individual is also a non-resident alien who makes an election to be treated as a resident alien for purposes of filing a joint income tax return. This situation usually arises when you have one spouse that is a U.S. citizen or resident, and you have another spouse who is a non-resident alien. And in order to file a joint income tax return, that non-resident alien spouse chooses to be treated as a U.S. resident. A specified individual also includes non-resident aliens who are bona fide residents of American Samoa or Puerto Rico. Specified foreign financial assets include foreign financial accounts. The most common foreign financial accounts are bank or brokerage accounts, for example. Foreign stock or securities. So you own stock in a foreign corporation. That's going to be a specified foreign financial asset. Ownership interest in a foreign entity. So that's kind of like a catch-all. So example, if you were a partner in a foreign partnership, that doesn't qualify as foreign stock because it's a foreign partnership interest. but it would be considered an ownership interest in a foreign entity, which would also make it a specified foreign financial asset. Specified foreign financial assets also include financial instruments or contracts with a foreign issuer or counterpart. So that's basically like a foreign insurance policy, like a foreign life insurance policy, for example, with a cash value, or an annuity. So jumping back a slide here, when we look at the definition of a specified domestic entity, so it says specified domestic entities are domestic corporations, partnerships, or trusts formed or used for purposes of holding directly or indirectly specified foreign financial assets. So when we look at the test for domestic corporations, basically what this test says is domestic corporations and partnerships are treated, are specified domestic entities if they are formed or used for purposes of holding specified foreign financial assets. So, they were formed or used for purposes of directly or indirectly holding stock in foreign corporations, ownership in foreign entities, foreign bank accounts, things of that nature, and are at least 80% owned by a specified individual. So we're talking about U.S. citizens, U.S. residents, and non-resident aliens in those two circumstances. And domestic trusts are treated as formed or used for purposes of holding specified foreign financial assets. So again, foreign bank accounts, foreign life insurance policies, things of that nature. If one or more specified individuals, so U.S. citizens, U.S. residents, and non-resident aliens in those two circumstances, is a current beneficiary. We'll get into what the definition of a current beneficiary is. So passive income, I think, is pretty self-explanatory, but just to be abundantly clear and so we don't miss anything, I wanted to include a comprehensive list directly from the regulation that defines passive income. So passive income is dividends, interest, income equivalent to interest, rents and royalties, annuities, and number 6 down here says the excess of gains over losses from the sale or exchange of property that gives rise to passive income described in items 1 through 5. So stocks pay dividends, for example, which are listed as number 1 here. So if you sold a stock and had a gain, that gain itself would be considered passive income under point 6 here, because it is a gain from property, the stock, which produces passive income, dividends listed in number 1 here. The list of passive income goes on. It's also the gains from futures, forwards, and similar transactions. It's also gains, foreign currency gains as defined in IRC 988, the net income from notional principal contracts, amounts received under cash value for life insurance, as well as amounts earned by an insurance company in connection with its reserves for insurance and annuity contracts. The definition of passive income does have a few exemptions. I think one of the easiest examples is probably that of a securities dealer. So a securities dealer may, a securities dealer buys and sells securities in the ordinary course of business. And so, if it had a capital gain or maybe received some dividends from, shares it was dealing in while holding them, that would not be considered passive income because it was received in the ordinary course of business. It would be considered ordinary business income. And passive assets, I think that's a fairly self-explanatory. Passive assets are assets that produce or are held for the production of passive income. So dividends, interest, rents, royalties, all the things listed here as passive income. So if we scroll back up here to our tests for determining whether a domestic entity is a specified domestic entity, for corporations and partnerships at least, we should be able to make that determination. So domestic corporations and partnerships are treated as formed or used for purposes of directly or indirectly holding specified financial assets, which again, bank accounts, brokerage accounts, life insurance with cash values, foreign partnership interests, things of that nature. If at least 80% of the entity is owned by a specified individual, so specified individuals again are U.S. citizens, U.S. residents, and non-resident aliens in those two circumstances that are listed, and at least 50% of its gross income or assets are passive. So we're talking about passive income, we're talking about interest, dividends, rents, royalties, things of that nature. And passive assets, we're talking about the types of assets that produce passive income. So stocks, bonds, trademarks that may produce royalties, things like that. So if there is a domestic corporation that has specified foreign financial assets, and it is at least 80% owned by a specified individual, and at least 50% of its gross income or assets are passive, then it is going to be a specified domestic entity. We're going to scroll back down here so that we can look at the definition of a current beneficiary, so we can determine whether or not a trust would be considered a specified domestic entity. So if you remember, that test is if a domestic trust has a current beneficiary that is a specified individual or a specified domestic entity. So a current beneficiary is any person who at any time during the tax year is entitled to, or at the discretion of any person, may receive a distribution from the principal or income of the trust. So if you have a specified individual, so a U.S. citizen, U.S. resident, or a non-resident alien in those two circumstances, that is a beneficiary of a trust that was of a domestic trust that was entitled to receive a distribution from that trust during the year, or could have received a distribution from that trust during the year had the trustee decided to, then that trust would have a current beneficiary and would be a specified domestic entity. A current beneficiary is also a holder of a general power of appointment. A general power of appointment is generally a power that is given to somebody to decide who should receive the assets of a trust, and that could include the holder of the general power of appointment themselves, or their family, or any other person. So we'll go back up and just take a look at the test for domestic trust again. So if you have a domestic trust that has specified foreign financial assets, and a U.S. citizen, resident, or non-resident alien in those two circumstances is a beneficiary that was entitled to receive a distribution during the year, or could have received a distribution during the year if the trustee would have decided so, or holds a general power of appointment, then that specified individual would be considered a current beneficiary, and the trust would be considered a specified domestic entity. So once we run these tests to determine whether a domestic corporation, partnership, or trust is a specified domestic entity, then we need to see if it meets the filing threshold for Form 8938. If it does meet the filing threshold for 8938, then it would be required to file it. Before we jump into the filing thresholds, however, I wanted to talk about how you determine the passive asset percentage. So if you recall, one of the criteria for a corporation or a partnership to be considered a specified domestic entity is that at least 50% of its assets or income are passive. So we went through the long list of passive income, and then we said that passive assets are any assets that are held or produce passive income. So how do you determine the percentage of assets that are passive within an entity? And the way that is done is it's based on a weighted average of the entity's assets. And you use that weighted average to determine if the specified, you use the weighted average to determine what percentage of the company's assets are either passive assets or produce passive income. And entities are given two choices in terms of what value to use for its assets. They can either use fair market value or they can use book value under a U.S. or international accounting standard. So if an entity is considered a specified domestic entity, then it would be required to file Form 8938 if it exceeds the filing threshold. So the filing threshold is if the specified foreign financial assets exceed $50,000 on the last day of the year or exceed $75,000 at any time during the year, then that specified domestic entity would be required to file Form 8938. Just wanted to briefly touch on some of the penalties for failing to file Form 8938. So the penalties for failing to file it can be pretty steep. So $10,000 for failure to file. That penalty can increase to $50,000 if that failure to file continues after the IRS has notified you that you should have filed it. One of the scariest penalties in my mind is the unlimited statute of limitations. Generally, the IRS only has the ability to go back and audit a tax return for 3 years. In certain circumstances, they can go back as far as 6 years. But with the passage of FATCA, they now have an unlimited statute of limitations in the case of certain international information forms not being filed, Form 8938 being one of those forms. So, for example, if you had a specified domestic entity that should have filed 8938 for 2016 and didn't, and the IRS figured that out 10 years from now, they could come back and audit that specified domestic entity's entire tax return 10 years from now, and they wouldn't have any statute of limitations problems. So obviously very important if a specified domestic entity has a Form 8938 filing requirement, very important that it fulfills that requirement. There's also a 40% penalty based on the underpayment of tax attributable to the unreported foreign assets. So let's say, for example, there was $100,000 of portfolio income from a foreign brokerage account, and let's just say that the tax on that was $35,000. There would be a penalty of 40% of that $35,000 in addition to the other tax penalties and interest that would be owed. The other danger, of course, is criminal charges if you intentionally didn't comply with your reporting requirements for Form 8938. Foreign banks and foreign financial institutions, they are reporting individual and entity accounts to the IRS. So if you think the IRS isn't going to find out about your domestic entities or your individual foreign accounts, think again. They definitely will. It's only a matter of time. If you need any assistance or have any questions regarding the subject matter of this webinar, feel free to contact us. Our contact information is here on this slide. You can visit our website at esquiregroup.com for additional contact information for our individual offices, or feel free to send us an email to our general contact email address, which is info@esquiregroup.com. Thank you very much for attending today's webinar. I certainly hope that you have found it informative.